Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today, we're diving into a filing from Venus Concept Inc. And it's a bit like watching a financial tightrope walker try to stay balanced. We'll see if they stick the landing or take a tumble. Venus Concept, a company that makes and sells medical aesthetic devices, just filed a report with the SEC about some important changes that happened in late February of 2025. The main story here is about extending debt deadlines and a reverse stock split. Basically, they're trying to buy themselves more time to get their finances in order and boost their stock price. First up, let's talk about debt. The company has been working with its lenders, Madryn Health Partners, to push back some important deadlines. They extended the maturity date or the final due date of their Main Street Priority Loan or MSLP loan agreement. It was originally due in December of 2025, but now it's been pushed to December of 2026. This gives Venus Concept another year to pay back the loan. Also, they were granted the ability to skip a cash interest payment to be instead applied to the principal, which they did. This amendment and consent agreement also included some relief on their minimum liquidity requirements or the amount of cash they need to have on hand. These requirements were temporarily waived through March, giving them some breathing room. But that's not all when it comes to debt. The company also amended some secured subordinated convertible notes with both Madryn and Yeo Healthcare Partners. These notes are basically loans that can be converted into company stock later on. The maturity date for these notes has also been extended from December of 2025 to December of 2026. Again, this gives Venus Concept more time to repay these debts or potentially convert them into equity. It's a way of kicking the can down the road, hoping that things will improve in the next year. There's one more loan amendment. Venus Concept also amended their bridge loan. The date was pushed back a little, but only from late February to the end of March in 2025. A bridge loan usually means temporary funding until something more permanent is in place. So the fact that they had to amend it is, again, not a great sign. Now let's switch gears and talk about something completely different, a reverse stock split. This is where a company reduces the number of its outstanding shares by combining them. In Venus Concept's case, they did a 1-for-11 reverse split. This means that every 11 shares of old stock became one new share. The change became effective in early March and began trading soon after. Why do companies do this? Usually, it's to boost the stock price. If a stock is trading at a very low price, it can be delisted from major exchanges like the Nasdaq. A reverse split increases the price per share, hopefully keeping the company in compliance with listing requirements. The company had to get approval from its stockholders, and the board approved the reverse split. It's important to note that a reverse stock split doesn't actually change the value of the company. It's more like cutting a pizza into fewer but bigger slices. You still have the same amount of pizza, but the slices look different. So, what does all of this mean for Venus Concept? Well, on the one hand, they've managed to buy themselves more time by extending their debt deadlines. This gives them a chance to turn things around and improve their financial performance. On the other hand, the fact that they needed to extend these deadlines and do a reverse stock split suggests that they're facing some serious challenges. I wish we could dive into the financials and see what we could find, but there isn't any useful information on revenue in this report. Overall, Venus Concept seems to be in a bit of a precarious situation. They are basically restructuring their debt obligations and trying to get their stock price up, but it's still a risky situation. Notable risks are definitely their high debt levels and the fact that they need to keep pushing back deadlines. If they can't improve their financial performance soon, they could face even more challenges down the road. It's a bit of a mixed bag, but definitely something to keep an eye on if you're interested in the medical aesthetic device industry. Thanks for watching. If you found this helpful, please like, comment, and subscribe for more corporate deep dives.